Hello and welcome. This is Word, and in this video, we will be going over our scans that we stream every day during market hours. We'll be talking about each scan and what it looks for, and we will be talking about how to use all this information to trade. So before we get started, there's a couple things I'd just like to touch on. Some of the terminology that we'll be using in this video and in our group comes from a trading system called The Strat by Rob Smith, and I'll leave a couple links in the description if you want to read a little bit more about that. But I like to go over it just quickly so that we're all on the same page, and it makes it a little bit easier to understand when we start getting into it. So the first thing about this strat, there's two main elements to it. There's two main ideas to it. The first being the candle scenarios. Basically, there's only three types of candles that can exist. And I'm going to go over those now. According to the strat, they're simply called 1, 2, and 3. So this is just a chart of Facebook. Um, and what we're looking at here is this bar, this red bar right here. Now this will be considered an inside bar, or according to the strat, it will be called a 1. And the reason why it's called an inside bar is the high did not take out the high of the previous bar, and the low did not take out the low of the previous bar. So if you look at it side by side, this bar is inside the range of the previous bar. Okay, so if we were to draw lines, this bar here will be inside the range of the previous bar. Okay. The second scenario, so this would be called a 1. Okay. The second scenario is a 2. These. The second scenario is a 2. Okay, and a 2 is something like this candle here, the last candle. Okay, a 2 takes out one side of the range, but not the other. Okay, so this candle here took out the high of the previous candle, but it did not take out the low. Okay, so a higher high and a higher low. This would be a 2 up because it's going up. Okay, a 2 down would be one like this. Okay, a lower low, a lower high. It's a 2 down. Okay, so this would be a 2 down, a 1, and then this would be considered a 3. Okay, and this is a little hard to see here. Make it a little bit bigger. But the low is lower than the previous low, and the high is higher than the previous high. So it's a higher high, a lower low. This would be considered a 3. Okay, also known as an engulfing bar. Okay, but according to the strat, this is a 3. So those are the three candle scenarios according to the strat. Now, we're not going to talk about this too much. We will talk about the inside bars in a little bit. Just wanted to briefly touch on this just to give a little bit of an overview. The second main element of the strat is time frame continuity. Okay, and time frame continuity, what that means, we'll pull some charts here, is when you're looking at multiple time frames, okay, are the time frames in alignment? Meaning, are they all a current green bar or are they all a current red bar? Okay, so looking at this chart here of Facebook, this is what we're looking at here is 8 different time frames. Okay, starting on the bottom right, we have the monthly, then we have the weekly, we have the daily, the hourly. Coming back up here to the top right, we have the 30-minute, the 15-minute, the 5-minute, and the 3-minute. Okay, the 4 major time frames when we're talking about the strat and time frame continuity are these 4 on the bottom. Okay, the month, week, day, and hour. And if all 4 of those are all in alignment, meaning they're all green or they're all red, then we have time frame continuity, or as we call it, TFC. Okay, so time frame continuity, why that's important is because we know that the market is driven by algorithms. We know that it's institutions and big money players using computers to trade. Okay. So as retail traders, we're not looking to beat them, okay, because we can't. All right. We're never going to move the market buying 200 shares at a time. Okay. Institutions move the market and they do it with algorithms. And we know this. So what we want to do is we want to do what they're doing, right? We just want to tack on and ride their coattails because we're not trying to beat them. We're just trying to play with them, right? If you can't beat them, join them. And so how can we tell what they're doing? Well, this is one way we can tell. Okay, we look at multiple time frames. And it's important to know this because the computers have to be programmed. Okay. And the computers have to be programmed, number one, what time frame to buy on. So when you look at multiple time frames, you're capturing all the market participants. Okay, because even retail traders, you and me, we trade on different time frames too. 5 minute, 15 minute, 1 minute, 3 minute, it's all over the place. So how do we know who's doing what? Well, we look at all the time frames. Okay. And when we have multiple time frames in alignment, and you can see Facebook, month, week, day, hour, 30 minute, 15 minute. Okay, we don't have a red candle till we get to the five, and the five got sold all the way down, and now it's coming back up. It's about to turn back green. So we were about to go back into full alignment. We only need four to be into TFC. Okay, but this is what we look for when we're talking about time frame continuity and multiple time frame analysis. Okay, I have a couple studies on a few of these charts, which is why you see these yellow bars. The yellow bars are just highlighting an inside bar. Okay, it's just a little bit easier to see, and the white bars would be outside bars. Okay, so it's just a little bit easier to see by glancing at the chart quickly. And I'll give a few examples in a little bit. So that's the strat in a real brief nutshell. There is more to it than that, but that's a real quick overview and just to help with a little bit of the stuff that we're going to be talking about here today. The second thing I'd like to talk about briefly is our watch list. We have a list, a main list of about 300 stocks that we run our scans through. So it's not wide open to the market. We would get too many results if we just opened it to the entire market. So we have a narrowed down list of still pretty big, about 300 stocks that we use to trade for the most part with our scans. And this is good because we tend to see the same stocks over and over, even though it is a pretty big list. But when you start to see the same stocks come up over and over, you start to learn their patterns. You start to see their ranges, and you can tell, what's a big breakout, what's not a big breakout, what might be a fake out, that type of thing. And you just start to learn the stocks a little bit more when you start to see them over and over. So, like I said, we do have a big list. If you're making your own personal list, you probably want to go smaller. Uh, you know, most people working the strat recommend 10 to 20 stocks, somewhere in that range. But you can have, more or less, or fewer, depending on how you want to do it. So that being said, let's get into the scanners page. The first column that we have here is simply just our watch list. It's posted here, sorted by percentage. Okay, we have two columns here, the percentage and the net changes. We have this one sorted by percentage, and this one does update during the pre-market, so we can take a look and see where the pre-market runners. And then the net is just the net change. We look at this in the beginning of the day, really throughout the day, but we can look at it in the pre-market to see what's moving before open. And also in the first, 5 to 10 minutes, we can take a look at the top of this list to get an idea of kind of where we want to focus in the beginning of the day. Also, I'd like to just take a brief moment here to mention before we get too far in that this whole page is dedicated to the long side. Okay, this is if you're looking to go long on stocks, buy calls, long on shares, that kind of thing. This is what you'd be looking at. We do have a completely separate page that is going to be looking at the short side. It's basically the same exact thing, but just geared towards the short side. So the TFC would be looking for all red candles on those time frames, and we would just be looking for the same criteria, but in the opposite direction. So these columns here, these next four scans that we have here under the time frame continuity heading, the first one we have is green on the month, week, and day. So when you look at these charts down here, okay, on the bottom row, if we just look at the current bar, current candle, is it green Yes or no? Okay. On the month, yes. On the week, yes. On the day, yes. And on the hour, yes. Now we're only for the first column, we're only looking for month, week, and day. So Facebook would have shown up there. And the inside bars, when they're yellow, if they're hollow, as you can see, my green bars are hollow. So that's how you can tell if it's a yellow bar. If it's hollow, it's green. And if it was filled, it would be red. So green on the month, week, and day will show up here. Okay. Now this is a good place to start no matter what you're really looking at. If you want to go long, this is a good place to start. If you want to do swing trading, if you want to do scalping, anything in between, this is a good place to start because you're green on the month, week, and day. Okay. So we know that participants on month, week, and day, they're all buying and they're all hitting the ask. That's why the price is going up. Okay. So we can start with those stocks right off the bat because having the month, week, and day green, we can start to look on the shorter time frames, 5 minute, 15 minute, 3 minute, whatever you want, to look for your entries. Okay. Going to the next column, this is the hour flip. Okay. And you'll see why I call it the flip here in a second. But these stocks are going to be green on the month, week, and day, but red on the hour. Okay. This is a screenshot of the scans from from a couple days ago. And so it's not going to be 100% accurate, the data that we have here, but I have a couple other examples that we can look at. Okay, so this is Shopify. Okay, so shop is green on the month, it's green on the week, it's green on the day, but it's red on the hour. Okay, it's red on the past 2 hours. So how do we use this information? Well, if we're looking to go long, okay, we want to look for stocks that are green on the longer time frames, okay, because the longer time frames is kind of like the wind at our back, right? It's like we're going with the current. We're already green on the month, we're green on the week, we're green on the day, but we're red on the hour. So we look at this hourly chart and we can even go down to the 30-minute or the 15-minute to see when is the hour going to flip back to green, okay? So maybe like this would have been an example down here a little bit earlier. This is actually the beginning of the day. Okay, so the day probably would have been red at this point because the day and the hour are the same at the beginning of the day, the first hour of the day. But we would have been green on the month, the week, and then when this started to go back green on the day, then we would have had full time frame continuity. And that's what we're looking for back here. Green on the month, week, day, red on the hour. Well, when this time frame goes back into the green, then we'll have full TFC across the bottom. Okay, and then we can look to go long. We can look to go long on this hourly chart if we wanted to, or we could go down to the 15-minute, 5-minute, 3-minute, and start looking for an entry on the lower time frames. Okay, different ways to find entries. I'm not going to go into that really in depth in this video, but just know that you can look at the longer time frames and then go down to the shorter time frames to pick your entries. Okay, now when is this going to flip? Well, it could flip in the current candle, right? It could start going up and turn this current candle from red to green. Okay, and then that would be an actionable signal. That would put it back into TFC. But more likely, what's going to happen is when the new candle forms, the new hourly candle, it's going to start green and start going green and just go up. Okay, if it's going to, doesn't mean it's going to. Could keep going red and start to reverse. Anything can happen, of course. But what we'd be looking for, if that were to happen, if it would start to reverse, then we just wouldn't take the trade long. Okay, if it were to reverse, then we could start looking at a long entry. More than likely, it's going to happen on the new candle formation and start going up. These candles on the hourly for the strat, okay, and in Thinkorswim, we have it set for the new candles to start at the bottom of the hour. So that's 10:30, 11:30, 12:30, etc. The reason why they have it set up like that is because so when you're looking at the 10:30, okay, 10:30 a new candle forms, you have a full hour of trading in that candle. If you were to look at the 10 o'clock candle, that would only be 30 minutes from 9:30 to 10. It would only be a 30-minute trading session. So it wouldn't be a full hour of trading. So We want to look at the bottom of the hour. Some platforms, some charting platforms allow you to do that, and some don't. The hour is one that will look a little different on our charts if yours doesn't do that. Okay, but this flip is what we're looking for. We're looking for this to flip back green. Okay, the same thing applies to the 30-minute and the 15-minute. Okay, so if we were to go down and here, okay, it's going to be hard to find a good example because we had a strong finish. So a lot of the stocks that were green on the longer time frames are going to be green on the shorter time frames. But let's see, we can kind of just make an example here. So if we were looking at Home Depot, Home Depot's green on the month, green on the week, green on the day, green on the hour, red on the 30-minute. Okay, it really was green. I just backed it up a little bit, but let's just pretend it's red on the 30-minute. Okay, same kind of concept. When this flips back green, then we're going to be in full time frame continuity from the 30 all the way to the month. Okay, possibly even higher. We're not looking at the quarter or the year right here, but possibly even higher. You can. And the same thing would apply to the 15. Okay, so we would have green all the way down to the 15. The 15 would be red. Okay, like you can get an example here. Let's just say it would look like this. Okay, um, green, 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 red. Okay, and then we would wait for this red to turn back green. Maybe in this candle, like this is looking like it's trying to get pushed back up, and possibly might go back green. More than likely, the new candle, the new 15-minute candle that forms, start green and start continuing up green. Okay, and then if we have full time frame continuity all the way down to the 15, then we could even go down to the 3 or the 5 to look for our entry if we didn't want to use the 15, which you could. Okay, there's a lot of different ways to use this information, and a lot of it's based on your own personal trading style. So that sums up the time frame continuity portion. Okay, these little circles here, 24, it just means that these instruments are traded 24 hours a day. That's not from us, that's from Thinkorswim. Moving on here to the inside bar scans. Okay, the inside bar scans are referring to the inside bars that we referred to earlier. Okay, the number one scenario on the candles is an inside bar. Okay, inside day yesterday is the first candle. Okay, and that's pretty straightforward. We're just looking for um, stocks that had an inside day on the previous day. Okay, so let's see if I can find an example here. Okay, Home Depot had one. This was a few days ago. Home Depot actually had this is the daily chart here on the bottom, and you can see by the yellow bars we had two inside days in a row. Okay, now why inside days are important? Inside days are periods of consolidation. Okay, as you can see by this big red bar here. Okay, and we always include the wicks. Okay, when we're looking at anything, we always are including the wicks because the price did trade there. So when we're looking at highs, lows, we do want to include the wicks. But we have it bid all the way up here. We have it sold all the way down here, and it kind of settled in the middle. Okay, so what this is saying is that there's a lot of discrepancy here between what buyers and sellers think is a fair price. Okay, there's a wide range. The next day, the range tightened. That means they're agreeing a little bit more on the price. Okay, the range wasn't nearly as big. The next day, it tightened even more, and now the range is even smaller. Okay, so why the ones are important is because it's not going to stay a one. Okay, a one is not going to stay a one forever. It can't. It has to break out on one side or the other. Which side? Well, we don't know. This was heading down, consecutive days in a row, so it could have broke on the downside and continued to go down, and it looked like it did that a couple of days after. But on the day after this inside day, okay, on this day is when it would have shown up on that inside day yesterday scan. So we had an inside day yesterday, okay, and it would have shown up there. And then we're looking at the next column over, trading above yesterday's high. Okay, so what that means is that we had an inside day prior. Okay, this is the break of the previous day's high. Okay, and the candle opened down here, went down a tiny bit, and then came up. When it broke above the previous day's high, that would be the inside day breakout, and we could look to go long. Okay, and as you can see, it had a decent run. Okay, the next day it reversed and came back down. This would be a two reversal. Okay, but when this breaks above the previous day's high and has that inside day breakout, we can look to go long. Okay, and also we're going to have the month and the week also green. Okay, so we'll have that as a little bit of a confirmation. Okay, and the same concept goes for these next two columns, they apply to the week. So it's just going to be an inside week breakout, same concept. Okay, the 1, 2, and 3 candlestick scenarios, they work on every time frame. So if you're trading on the 1 minute or if you're trading on the yearly time frame, the same concept applies. It's going to be a 1, 2, or 3. It can't be any other way. Okay, and you can apply these inside bar breakouts to any time frame. All right, the next set of columns that we have here on the top right, we have the TLVX on the 5 minute. Okay, TLVX, what that stands for is trade line crossing VWAP. Okay, and the VWAP is the volume weighted average price. Okay, and it's used pretty heavily in algorithmic trading and institutional trading. And one reason that it's um, very useful and very widely used is that the VWAP is the same. It's going to be at the same point on any time frame. Okay, so when you're using moving averages, if you look at the nine period moving average, that line is going to look different on different time frames. If you're looking at it on the 5 minute, the 15 minute, the hourly, it's going to look different because you're averaging a different set of candles, right? You're averaging different periods. The VWAP is the volume weighted average price, so it takes into account volume and price. And the volume and the price is the same no matter what time frame you're looking at. So that's one reason why it's a very good tool to use when you're trading, because you know everybody's looking at that no matter what time frame they're on. The VWAP looks the same. Okay. In this case, we're looking at the 5 minute time frame, and if the trade line, okay, the trade line for us is the 9 EMA, okay, 9 EMA on the 5 minute, and does it cross the VWAP? Okay. I'm not going to go too much in depth. Could be a whole nother video, okay, but just know that that's what this looks for here. All right, this next column that we have here is a primed for launch. And some of these, like these 4 columns that we have here, these 4 scans, they're kind of experimental. We do rotate these from time to time. These have been here for a little while, so they probably will stay for a while longer, but we tried this out and it seemed to work pretty well. This is a series of moving averages. We don't use a ton of moving averages, but we do use some. And this one here is a series of moving averages that we've kind of highlighted to give us some potential runners in the next day to 2 days. Okay, the 9 crossing 50 on the hourly. It's another similar type of moving average, looking for like a launch type of scenario. This is the 9 EMA crossing the 50 SMA on the hourly. Okay, that's pretty straightforward. Okay, these two down here, the momentum 15 minute and the runners 5 minute. These are 2 scans that are just trying to capture the momentum shift on the 15 minute. Okay, and trying to catch runners on the 5 minute. So the runners is, I believe, 3 consecutive higher closes on the 5 minute time frame. And these scans in and of themselves, like these 4 scans, the TLVX, the prime for launch, the momentum, and the runners, aren't necessarily meant to be used on their own, but kind of in combination to everything else. So when we're looking at hot stocks, And this is just a screenshot here because the markets aren't open. I'm recording this on the weekend, so this is a screenshot. But during the market hours, if we were to click on one of these names, if it shows up on multiple scans, it'll highlight. So Clove is here, 1, 2, just looking at it real quick. I don't see it on any of these other ones, but sometimes they'll pop up, 6 or 7 scans a stock will be on. And that's just a bullish sign in itself, right? So some of these aren't meant to be used on their own, but more just in combination as a little bit of an extra confirmation on the rest of them. Okay, coming down here to the A plus scans. The A plus scans are scans that started out as experimental scans and just have kind of evolved. They just add a few additional filters to kind of bring the cream of the crop, so to speak, to our attention. The first column here is TFC plus 1.5 up, and that's basically just, it's a time frame continuity scan. It's green on the month, week, day, and hour, and it is up 1.5% on the day. Okay, that's going to show up here. The the TLVX with volume is going to show up here, and this one is the TLVX 5-minute, but with an increase in volume. So one thing that we look for when we look for the TLVX is there an increase in relative volume during the cross, okay? And this scan here will pick that up. The third one is experimental. This one we change pretty regularly, and so this one I don't have a label on it at the moment because we do change it up, but it is just a similar A plus with additional filters scan on it. This one here is a new one that I just added. 2 red days gap up. Let me show you an example of this. This is one that I've been looking at for a while, and it does have some runners. So this is Fubo from Friday, and if you were watching Fubo, it had a big run, and it's been trending down. It had 2 red days in a row, and then a big gap up. Okay, this pattern, sometimes it produces big runners, and sometimes it produces runners in the opposite direction. So I like to look at this scan. It's really a once a day scan. It's not going to change throughout the day. It's just a once in the morning type of deal. But some of these stocks, they can run, and also on the opposite side, it's 2 up days and a gap down on the short scans. But what it looks for is 2 red days in a row, and then it gapped up. It's any gap up. So I think it had another one actually back here. This is 2 red days here and a gap up, and you can see it just kept going. Okay, and it had a big day that day. It's usually that first day that it hits the scan is going to have a decent move in one way or the other. So it barely gapped up. It was just a few cents, I think 10 cents, but it did gap up and it continued to go. Okay, and the same thing happened this Friday. It gapped up pretty big, and it had a nice run. The other thing that could happen is it could gap up and then come back down. So that's another thing that you'll see is a runner to the downside for the majority of the day. That can come up on this scan too. If it gaps up wildly and it doesn't hold, it just comes back down. So that scan I just included. And so you can look at that in the mornings. And the last one that we have here is the X versus SPY. And what this is sector ETFs versus SPY. Okay, so SPY for the most part is the market benchmark. It's usually in the middle of this list or pretty close to the middle. And then the ETFs on the outside usually flip flop. Okay, so how we use this is a couple different ways. We look at it, number one, and see what industries or sectors are really leading for the day. Okay, we do have a couple other things in here like GameStop's on the board right now just to see where it's at, and RK we have in here. So there's a couple other just kind of industry big names, but for the most part we're looking at the sector ETFs, the industry ETFs, and where they're at versus SPY. So the ones that are up on the top, like you can see, XLK was really ripping. Okay, is the tech. What we can look at in there is in XLK, what stocks are in there that are contributing to this being boosted up to the top of the list. Okay, and we can drill down into those stocks and see which stocks we might want to trade. Okay, and I bet if we look over here on the watch list gainers, a lot of them are going to be in XLK. Okay. So that's one way we can use it. The other way we use it is we can try to forecast and see what is due for a reversal. So what we'll look at here, okay, we do have the VIX down here, or the VXX, just to see where the volatility is at. But if you look at the first one here, it's XLE, the energy sector, it's down, okay, on Friday. Well, I would not be surprised if on Monday it's at the top, okay? These like to flip-flop, and tech will rotate down to the bottom, okay, or near the bottom. So what we can do is we can get an idea of what's going to happen next, okay? It's not a sure thing. It doesn't happen every day. It's not like a flip back and forth guaranteed, but you will notice patterns between the top and the bottom. Ones that are up, they don't stay on the top, and ones that are down, they don't stay on the bottom for very long. So if we are looking to take stocks long in the energy sector, this might be a good day to see what stocks are down on the day but are up on the month and week. Okay, we can start looking at individual charts. All right, which touching on that, looking at all these scans, we never want to trade from a scan, of course. You know, we always want to look back at the chart. We always want to refer to what the stock's actually doing. The scans run every few minutes. Okay, so if you're looking at, like, say, this 15-minute chart or the 5-minute runners, they may not be accurate in that moment. Okay, because the price could have changed drastically before the new scan could update. Okay, because it updates every 5 to 10 minutes, I believe, for Thinkorswim. So that's also why we don't go lower than 15 minutes on the flip, um, because it starts to get a little bit inaccurate. Okay, so there's one thing to keep in mind. Always look back at the charts. Always start with the scans and finish with the charts. Okay, good rule of thumb. So once again, I'd like to just talk about the short scans. We do have two separate scans that we stream during market hours. This one is going to the long side, and we also have the same exact setup to the short side. Okay, I'll post those links in the description. And that will wrap it up for this video. Thanks for tuning in, and hope to see you in the next one.